You really hate freedom. I mean, yeah, it's a terrible concept. I think this election has proved that people are far too stupid to determine their own best interests. Anyway, pretty close to the bottom of the market maker expected move. We dropped a little bit below it, found support at the, was that the 2 standard deviation view up? I think it is. There's no way we're anywhere near the actual one. Yeah, uh, three standard deviation view up. Gross. This does look like it's failed though. Lower high, inside candle, decent rejection. Could continue to break down. Obviously, CPI will have some effect on that tomorrow though, so we don't know yet. Same thing on futures. Rejection at trend, starting to break down. Still haven't managed to hold a loss of 6,000 yet, but multiple tests at that level will probably show some signs of weakness. Commodities still driving down. I think HSI still falling off a cliff. Lost 20,000 last night. Dollar up. Oil kind of flat on the day, but still decent losses in gold and copper. Silver gained a little bit, and not much in agricultural commodities. Yields up today, along with the dollar. Dollar broke the 106 level, failed, fell back to 105. This is support. If dollar finds support here, I would expect it to start moving up to the next even higher level, especially as we see the 2 and 10 diverge and the bear steepener kick in. This is not good, obviously. Correlation's still pushed, so we've still got a lot of short vol on the chain. There's still quite a lot of long vol on the underlying components of the S&P 500. That's going to make the market like really bouncy. So be careful of downside moves while correlation is really low like this, because they'll reverse really hard. Leverage on the carry up to 8.4x, and getting very close to its all-time highs again. That leverage is also increasing on the short end, although not nearly as much. This looks just broken. It's almost like they can't run away from the cost to carry fast enough, and it's all going to collapse at some point. In the meantime, though, forward yield on volatility still negative. I think we maybe popped up a little bit there yesterday, but today it stayed negative most of the day. Bond vol's going to be more elevated after today's price action, probably back over 100. Skew still dropping and pretty quickly. Keep an eye on that. If skew continues to decline and more tail risk hedges are picked up, that really opens up the potential for some downside on the indexes. 64.61% of the S&P over its 20-day moving average. We're still seeing vol getting shorted pretty hard here, down to about 75% correlation between VIX, cash VIX. VIX at like 14.71 right now. VIX futures at 15.25. I don't know if we're seeing it drop off enough to really feel the effects out on the weekly. Yeah, the week over week change is still largely unaffected, which means that, obviously this has a much greater chance of snapping back, as they continue to compound their risk on a downside move. Fed fund futures now pricing in less than zero point 0.4 rate cuts by June of 2024. This is just falling off a cliff. As the bear steepener gets worse, it's going to fall off even more. If inflation is hot tomorrow, we're going to see probably a big move in Fed fund futures and yields. They will absolutely break out and push towards, like that 10-year at 5% level. So keep an eye on that. I think there's a very good chance that we do see CPI above 0.2 tomorrow. And if that's the case, that compounds the effect of the rate cuts that are already in place and lowers real rates below a level where the Fed has any power to control the effects of inflation. 10-year, 2-year spread increased today. This is indication of the bear steepener here, right? We got the election, we almost reinverted, and now it's pulling back around and yields are going back up. Performance-wise today, still a little bit of performance in the tech services is still kind of leading, and Apple flat, Nvidia up, but the rest of electric tech down. Finance sector falling, which we kind of discussed with today's Sluice report. And that was not very good. There was no significant liquidity improvements in credit markets per senior loan officers. And it looks like banks are starting to price up interest on loans as risk compounds. Health technology falling off really hard, consumer durables, producer manufacturing. Retail trade picked up a little bit, but this is largely seasonal, and expectations for the coming earnings and coming projections from those earnings across that sector. Services, utilities, like pretty much everything else down. So a little bit of tech and a little bit of tech services, and then a little bit of retail trade, and then the rest of the index kind of shitting the bed. IWM also, this should be noted, IWM fell almost 200 points today. It's got plenty of room to fall back to the downside, to that level where it had previously found stability around 220. Obviously, we're not seeing rates come down. These companies and the finance portion of this index are all extraordinarily exposed to high interest rates. And so, if these rates continue to climb and they're starting to climb to levels that actually present risk to regional banking, we will probably see IWM continue to sell off, and possibly even harder. Spot up huge in AF. Oh, Spotify. They have earnings tonight. Nice. Well, 10%. Not too crazy. Gold's been selling off a bit because the dollar is going up so quickly. I think if the dollar stabilizes or falls, gold will go back up again. Because they need to, they'll still need to hedge the other side of that currency risk. I'm not getting drafted. It'd be useless on a battlefield. Anyway, that's it for today. I'll see you guys tomorrow. Have a good night, everybody.